Most investors fall into either the growth dividend or income dividend camps. We are going to look at both today and maybe answer that question as to which camp is better. Fasten your seatbelts, folks. This is going to be a good one. Technically, there are three main camps of investors if we want to include the pure growth investors. However, in most cases, they do fall under the dividend growth banner. And for the purpose of today's discussion, we are going to treat them as a subset of growth dividend investing. Before we really dive into this topic, let's just take a few moments to cover the basics. First off, well, what are dividend stocks? They are shares in companies that return a portion of their earnings to shareholders in the form of, well, dividends. They are favored by investors for the regular income that they can provide. There are, of course, two main groups, as we have already mentioned, the growth dividend stocks and the income dividend stocks. Typically, dividend growth stocks have smaller dividends, though they are often increasing them over time. Thus, many growth dividend stocks show up on the Dividend Aristocrat Index. Income dividend stocks, on the other hand, they offer much larger dividends up front, but often at a cost of their growth, and that can include not increasing their dividend as often as a growth dividend stock. Let's dive a little deeper into those dividend growth stocks. These are typically companies with a track record of consistently increasing their dividend payouts year after year. They are often in the growth phase of their business cycle, which allows them to reinvest a portion of their earnings back into business to fuel further growth and simultaneously increase the dividends paid to shareholders. If you have been following this channel for some time, you will often hear me referring to dividend growth stocks as total return stocks. The reason for that is that these are the sort of stocks that can hit really high total returns when you add in their dividends to that growth. In addition, of course, to having some impressive total returns, these companies are often very sound when it comes to their fundamentals. They often possess robust financial health characterized by steady growth revenue, strong profit margins, and manageable levels of debt. Though, of course, not always. There's a few there that have more debt than I like. We all know this. They can be a very powerful part of a total return strategy to grow your portfolio with strong growth and moderate dividends. Now, switching gears over to those dividend income stocks. These are shares in companies that offer high dividend yields relative to the market average. They are often associated with mature companies in established industries that generate consistent cash flows. Of course, not all of them are in that boat. We got them covered call ETFs as well. And these are funds that own underlying assets like dividend-paying stocks and pump up their income generation through an option strategy known as writing covered calls. This strategy involves holding a stock and selling call options on the same stock to generate additional income from the option premiums, which is especially lucrative in flat to moderately bullish markets. Covered call ETFs are particularly appealing in the context of dividend income stocks because they combine the regular dividend income from these stocks with that option premium income, and this allows them to offer enhanced yield potential. This can be an excellent way for investors to maximize income in a low growth environment. However, it is essential to understand that, well, there's trade-offs involved. While covered call ETFs provide higher income, they may cap the upside potential of the portfolio since the sold call options may require the fund to sell the underlying stock if its price exceeds a certain level. Moreover, in a sharply rising market, these ETFs may underperform relative to the broader market because part of the stock gains is sacrificed for premium income. In a nutshell, dividend income stocks and covered call ETFs provide robust options for investors prioritizing income over growth, combining relative safety with potentially higher yields. Join today's conversation. Let me know in the comments which camp of investing you fall into. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. Now that we have the basics behind us, let's investigate those potential returns and see just how these two investing strategies, well, let's see how they stack up. In a strong bull market, you are going to really ramp up the returns with a dividend growth stock, and the total return on that stock will be hard to beat. In a bear market, those same stocks can be struggling to rack up the growth, and with their growth component lower or negative, they do not look as impressive. It can be tough watching a red portfolio during during, well, those less than stellar economic times. With the dividend income stocks, you do have the dividends making up much of your return. And thus in a bear market, they will be pumping out the dividends to make a red day feel a little bit more positive. For an example, I did grab 3 of the best dividend growth stocks as well as 3 great dividend income stocks so that we can check out their year-to-date total returns. For the dividend growth team, I picked Propel Holdings, Hammond Power, and TerraVest Industries. For the dividend income group, I went with the Purpose Bitcoin Yield ETF, Horizons Enhanced Canadian Oil and Gas Equity Covered Call ETF, and the BMO Covered Call US Banks ETF. In a moment, I will show you their total returns for 2024, and we will undoubtedly see how huge dividend growth stocks can perform in better market conditions. So PRL has a total return of 78.44%, HPS.A came in with 70.52%, and TVK finished with 68.31%. Holy banana bread, that's pretty impressive. These are huge numbers, and of course, not all dividend growth stocks will hit numbers like these. On the dividend income side, we had BTCY.B coming in at 34.89%, ENCL at 20.63%, and ZWK finishing at 12.70%. These are also some pretty good numbers for income stocks. With such a high difference, some folks may be wondering, why even bother with passive income stocks when you can make bigger returns with the dividend growth stocks? That is true for the most part, but depending on your investment strategy, you may want more exposure to passive income. Some retirement portfolios, for example, may be set up to simply generate tax-free income that the investor can then use to, well, to supplement their retirement supports. You could do the same thing with dividend growth stocks, but in that case, you would need to sell some of your shares. If you had 1,000 shares of a fictional banana coal company at $10 per share, and they went up to $10.25, that is a $250 profit. You could sell, let's say, 20 shares for $205 and use that as your income. You are then left with less shares, but the value is still above where you were before. I will caution you guys that the one reason most people do not do this is that when the market goes down, you have nothing to skim off the top, and thus you may have very little income from that stock that month, whereas a dividend income stock would still be giving you those nice dividend yields. There is no hard and fast rule that you have to be one or the other, and in most portfolios there is usually a mix of both a dividend growth and income stock. In fact, the younger portfolio will more often be more heavy on the dividend growth side, while the retirement portfolio often flips to a heavier dividend income strategy. The best fit for you, of course, is one that meets your portfolio goals within, of course, well, your acceptable risk level, and that will look different from investor to investor, and that's perfectly fine. Let's continue that learning journey. Check out this video on the 0 to 100K challenge, and I will see you in the next video.